Eva Agi's with us, investment advisor representative at Gerber Kawasaki Wealth Investment Management, and Keith Gangle, portfolio manager at Gradient Investments. Thank you both for being with us. So, Eva, I'll start with you. Your thoughts on what is going on here, and maybe are some of these names really in a good spot?
Well, Nicole, thanks for having me. Great to be here as always. I think there's no shortage of bad events that we're hearing. We're hearing inflation, high interest rates, high oil prices, supply chain, and ultimately, these macro events are driving the market down. What that's doing is creating, as your guest said before, more buying opportunities. I think it's really important to realize where valuations stand and where investments can get a piece of that pie for a little bit cheaper.
So that's the whole thing. You know, if you used to like them before, why wouldn't you buy them when they're 20% lower? Keith, what are your thoughts on the group? And do you have certain names that you like more than others? I know you had thoughts on each one of them.
Yeah, we like the space a lot here. So like your other guests were saying, the market's actually on sale here. These large cap tech names are down 25 to 45% in a short period of time year to date versus the S&P down 20%. So valuations used to be above the S&P 500. Now they're below. So we think it's a great opportunity to buy these high growth names that are secular winners. They have competitive moats and they're actually profitable. So those are the kind of names we like. We like Amazon, that group. We like Meta, and we also like Google.
Amazon, Meta, and Google, Alphabet, right? What do you like, Eva?
So those are some of our top holdings as well. But what I really like is Apple. I think from a product perspective, given what we've seen from their last quarter earnings, they're still able to produce. Granted, supply chain will affect them, but they have a moat. As all of your guests have mentioned today, these FANG stocks have diversified revenue streams. A lot of their money doesn't only come from selling products, it also comes from software. Amazon's another area where AWS drives a lot of their revenue, and it's an area we like as far as a diversified play.
Yeah, Eva, I wanted to expand on the Apple thought first. You know, you talked about the moat that they have, the products. Obviously, you have the Apple ecosystem. People love to have an Apple phone and an iPad and their watch and their Big Mac at home, and not Big Mac, but a Big Mac computer at home, and you know, while they are wearing their AirPods. So tell me a little bit more about the Apple play. You know, we just saw it around 135. I mean, there were times people were calling for 200. This was the largest company. Where do you see it heading over 6 months, 12 months, 3 years?
Well, we don't look at price targets, but mostly what people are going to be using in the next 5 years. That's how, when we evaluate a stock, is do we want to keep it in our portfolios? Well, is someone going to be using an Apple product or upgrading their Apple product? I mean, we have the whole suite, and that only keeps expanding. So as far as getting your iPad and AirPods and MacBook, those are going to, investors and consumers at large are going to keep getting new ones. That's been the trend for many years now, so that's a strong revenue stream. Also, inflation plays really well here. If they're able to raise their prices over time, that accounts for more revenue down the road. So those are a couple of reasons why we really like them.
Yeah, and you've both talked about Amazon and Amazon Web Services. I would love if you, Keith, could expand on that play and why this may be a good time to get into that company.
Yeah, we really like the stock here. It's actually been underperforming for almost 2 years now. It's underperformed the S&P 500 by 50% for the last 2 years. Part of that underperformance is due to their investment in CapEx, which we ultimately think drives their long-term growth in the retail side of things. AWS has been a rock star for them. That's growing 36%. We expect growth on AWS to be 30% plus for the next several years. So that's a winner. Retail, I think, will get better as inflation. They spent a lot of money on CapEx. They overhired. I think they'll grow into that, which is a good thing. So they have space to grow. And AWS, like I said, is growing 30% plus, and we don't think that'll change in the next few years.
What I think is interesting, Keith, in your notes is how you're saying that you believe these stocks can do well regardless of if we have a booming economy or an economy that's slower or slowing. Is that because you just think they're so resilient, so needed, we'll continue to see demand regardless, Keith?
Yeah, valuation, like I said, started out a little higher than the overall market. Now they're cheaper. And when people start to get nervous and talk about recession, they'll look for growth names because of scarcity. And we think large tech's going to be at the top of the list. It's Apple's of the world. It's going to be Amazon's. It's going to be Alphabet. It's going to be Meta, things like that. So those are names that should do better than the overall market in a slower time period. And again, now if the economy does very, very well, ad spend should increase. So that's going to help these companies as well.
Yeah, and I know, Eva, you were saying that you like companies like Apple, Microsoft, Google. They'll continue to perform well. And as inflation starts to come down, that would be even better for this group?
As inflation comes down, that's definitely positive for the economy. The economy is basically driven by macro events right now. So until we get a reversal of inflation or lower oil prices or all of the things that are really affecting the broader economy right now, that'll give these companies an area to climb back up. But I think that as far as companies go, these are some of the strongest, and we like their standing capability through thick and thin.
Yeah. It's great to see you both. Thank you very, very much. Obviously, we're watching these levels, bear market territory for the S&P, but I'm glad you're able to come on and give us some optimism pertaining to the FANG names. Eva Agi, investment advisor representative at Gerber Kawasaki Wealth Investment Management, and Keith Gangle, portfolio manager at Gradient Investments. Thank you both.